Hi, and welcome to the ECIO first quarter market commentary. The first quarter was a mixed quarter for investors as equity markets started on an upswing in January and February, but had a sharp sell-off in the month of March. Overall, the S&P 500 lost 4.3% in the quarter, while the other indices were in positive territory, highlighted by dividend-paying stocks, which gained nearly 13%. Overseas stocks were modestly negative. Fixed income results were flat to modestly negative. That takes the one-year return for equities up double digits in all cases, and for fixed income results up mid-single digits. The same thing is true on a three-year compounded return, mid-double-digit returns for equities and mid-single digit returns for fixed income. Looking at the S&P 500 over the past 15 months, a little bit of deja vu. First quarter of 2025, we had a big sell-off driven by tariff and trade concerns. Come to 26, first quarter, similar situation, different causes. This was the U.S.-Israeli-Iran war. So we saw about a 9% downdraft from January through the March 30th, with a sharp rebound the last day of the quarter. From a sector perspective, we saw energy stocks up 38%. Other gaining sectors you can see here on the downside, financials, technology, and communication services stocks led the way lower. So all in all, during the quarter, equities neared correction territory. In fact, the NASDAQ, Dow, Russell 2000, and some of the overseas markets did decline over 10% intra-quarter. So that definitely meets the definition of a correction. A late quarter rally, the last day of the month, prevented the S&P 500 from falling into that same correction territory. So it was down about 9% from January through March 30th. That decline largely was led by the big technology companies. And on the opposite side, as pointed out, dividend-oriented stocks did very well. Bond results were mixed as longer-dated interest rates did increase during the quarter. So that tilted the Bloomberg Aggregate Index into slightly negative territory. Other fixed income results were positive, including short-duration strategies, along with many private credit funds. Geopolitical issues really drove the day. As mentioned, the first quarter of this year echoed last year's first quarter with sharp market swings. In this situation, the Middle East conflict, energy markets remain a focal point, with the Strait of Hormuz representing about 20% of the transportation of global and oil gas flows for the world. So that's a big issue. On the central bank front, the Fed did meet in March, held policy rates unchanged. They did signal just one rate cut potentially for 2026 in their updated projections. Also in the quarter, the Supreme Court did strike down part of President Trump's tariffs. The administration did respond quickly, reimposing broad tariffs of about 10 to 15% under alternative trade authorities. So time will tell whether or not those will stick. Private credit came into the headlines, triggered by some retail and private wealth redemptions, despite the fact that index data shows relatively low default and delinquency rates versus historical cycles. I'll talk a bit more about that further in our presentation. Overall, economic growth forecasts were revised down, reflecting the higher energy prices and the impact from the conflict. The duration of this conflict will certainly influence the magnitude of those growth forecast reductions. So going forward, we think investors are really going to be focused on this conflict, its implications for energy prices, inflation, interest rates, and ultimately global economic growth. So that's a quick recap. Since it's quarter end, I'm going to go into more detail on a number of these issues. If you have the time, stick around. Starting with the S&P 500, we've talked about this in the past, the big tech's influence on the returns in the S&P 500. You can see the S&P 500 for the first quarter was down about 5%. The Mag 7 stocks, those big technology companies, were down about 11%. The remaining 493 companies we're down about 1%. So we're seeing that differential in the opposite side now. And in green, you can see the Magnificent Seven stocks. They have led the way higher. And then since the end of 2025, have led the way lower. As a result, the composition in the S&P 500 is starting to change. We talked about the top 10 companies and the percentage of the index that those 10 companies make up. That's illustrated here in this gray line over time. We peaked out at about 41% with the sell-off in those big technology names. The top 10 companies now represent about 38% of the index. Still a very elevated level, and we would expect that probably that comes down further. Looking at what will drive stock prices in the long term, it really comes down to fundamentals, that being earnings and profit margins. This chart shows the S&P 500 earnings growth rate year by year. So for 2025, that is about 13%. The expectations for this year, 2026, is 17%. And then you can see double digits expectations for 27 and 28. So that's what we need to see materialize to continue to propel stock prices higher. When we look at profit margins, interestingly enough, we are at record high levels set. This number came in at the end of 25 at 14.1%. Likely, a lot of that is driven by productivity gains, driven by some of the AI implementation. And in fact, that likely is going to be a long-term economic growth driver. We've illustrated in the past the major expenditures going on by the big AI hyperscalers. That's Alphabet, which is Google, Amazon, Meta, which is Facebook, Microsoft, and Oracle. For 2025, this number originally was projected to be 400 billion. It came in at 416 billion. So huge number as far as capital expenditures. These are the expectations looking forward. So over the next 3 years, that number is expected to almost double to close to $800 billion. When we look at the companies that have adopted AI, only about 20% have adopted AI in their business so far. So there's a long ways to go here. You can see it varies a lot by sector and area as far as the adoption rates, but we expect this to continue to climb quite significantly. Turning to private credit, credit came into the headlines over the past couple of quarters, so we thought we'd take a minute and talk a little bit about that. First of all, what's driving private credit? This is U.S. bank lending to companies. You can see in 2000, banks accounted for about 35% of the lending. That's been on a sharp decline, partly driven by regulation, making it more difficult for those large banks to lend money. Today, the banks make up about 20% of the market. So the difference here has largely been made up by the private credit market, and you can see that growth over here in the different areas. Direct lending is the area we've talked mostly about. That's here in gray, and you can see the rapid increase there. There are also other assets that have flown into distressed debt, real estate debt, mezzanine debt, and others. So this has become a very significant market and will likely continue to grow over time. When we look at the yields that private credit is providing, that's here in orange over time, compared to levered loans. So those are here in light blue, high yield bonds, and then the short-term lending rate, which is SOFR here. So you can see private credit offers a spread of about 5% plus over that short-term lending rate. Pretty significant enhancement over some of these other areas. When we look at default rates for these areas, you can see private credit in orange. Those default rates have come down since 2020 and are currently hovering at around 2%. There was a little tick up here, but nothing that's really alarming. You can compare that to high yield bonds and levered loans. So, and important to point out, default rates do not mean loss rates. So when a company defaults, there typically is a recovery. So usually 50% plus is recovered. as the company either rebounds or is liquidated. And those private credit investors, if they're first lien holders, receive first dibs on any of those remaining assets. So the actual loss to investors tends to be a lot lower. So, in our opinion, there's not a big reason to be concerned about private credit today. It's mostly a headline issue, largely affecting private wealth investors in some of those semi-liquid investment vehicles. Turning to inflation and interest rates, when we look at the inflation numbers, the most recent print was in February, came in at 2.4% for the consumer price index. Now, you'll see when you look at the components of this, there's no green section, which is energy. So green or energy has not played an impact on inflation for the past several quarters. That is about to change with the rapid rise in energy prices. You can see that here. The price of oil at the end of December was about $55 a barrel. That has almost doubled to over $100 a barrel. So that will have impact on consumer spending and inflation rates. That translates over directly to consumers in the form of gasoline prices. And here you can see in 2026, we came into the year with a gas price of about $2.75. At the end of the quarter, we were approaching $4. So this will likely have impact on consumer spending and the way this plays out, depending on what happens with the conflict in the Middle East, and in particular, the Strait of Hormuz will have a huge impact on this. So that leaves the central banks kind of in a checkmate situation where they're not able to necessarily lower interest rates because of inflationary pressures. And that's what you see here. This is the Fed funds rate over time. This green line is the expectation from markets looking out into the future. So basically, the market is expecting short-term interest rates to stay pretty much where they're at. The Fed's expectations are here in blue. So the Fed is expecting maybe more of a rate cut than what the market is pricing in today. That, of course, is subject to revision. But either way, it doesn't look like the Fed is going to be aggressively cutting interest rates. So that's impacted yields. This is the Treasury yield curve, looking at yields on Treasuries from a 3-month Treasury out to a 30-year Treasury. This dark blue line represents the end of the quarter. The light blue is where we started the year. So you can see over the past quarter, yields have moved up, again, reflecting the higher energy costs and the costs of the likely impact of the conflict on inflation. So there is some pressure on those longer dated as well as short dated interest rates. So where does that leave us for bond investors as we look forward? This is a great chart. It looks at historical observations of starting yields for bonds and then subsequent 5-year annualized return. Each of these dots represents a different historical observation. This line represents the regression line. It has good explanatory power, about a 90% correlation. And this is telling us today at the end of the quarter with bond yields at about 4.6%, that is actually the expected return looking out over the next 5 years is about 4.6%. That squares with our thinking of kind of 4 to 5% for investment grade bond investors looking out over the next 5 years. As far as stocks, it's more complicated as stocks are much more difficult to project as far as forward returns. One factor we look at is the price earnings ratio, and that's mapped out here over time. You can see today the price earnings ratio is at about 19 times earnings, which is at a higher level, likely portends for lower future returns than what we've seen historically. So historical equity returns long term have averaged at about 10%. And then finally, this chart, which we've shared before, shows annual returns for the S&P 500 in gray. So you can see about 3/4 of the time, so 35 of the 46 years, equities have been in positive territory. So about 3 out of every 4 years. When they do drop intra-year, the drops are fairly substantial. That's about 14%. And you can see each of these red dots represents what happened inside of that year. So from the highest point to the lowest point within each year. Here we are today. Again, the S&P 500 down about 5% for the quarter. We saw a 9% drawdown from the peak in January to the low on March 30th before the rebound occurred. So, this just sets the expectation for stock investors to expect volatility. On the other hand, stock investors have been very well rewarded from a long-term perspective. So that concludes our brief update for the quarter. If your investment committee would like to meet with us, please reach out. Happy to do that at any time. Thanks for your time and interest, and have a great day.